All right, let's do a metrics rundown before we get into how the software sausage factory is financed. So revenue, FY 2025 fiscal year, 1.3 billion. That was up 95% year over year, up from 671 million in 2024, and then up from 387 million in 2023. That's an 84% two-year CAGR. Q1 of 2026 did 601 million, up 132% year over year. Organic revenue growth, FY 2025, 13%. So if you strip out the acquisitions, that's what the underlying portfolio actually grew. It was 7% in 2024. So they went from 7% to 13%. So roughly 82% of the 95% growth points in FY 2025 were bought, not built. Trailing 12-month revenue, if you give them a little more credit here, through March of 2026, it's 1.6 billion. Gross margin, 66%. So this is if you smash them all together. It's 66% in 2025, 68% in Q1 of 2026. So it is climbing every year. It was 61% in 2023. Honestly, it's not that stellar for a group of software companies to only have a 60% gross margin. You'd expect it to be higher, but I have to keep reminding myself, it's not just like simply software companies. It's a portfolio of assets here. Subscription revenue. So where does that revenue come from and what is the makeup of it? 84% of Q1 2026 revenue was subscription. 12% was advertising, 4% was others. It was 95% in 2023, 92% in 2024, and 93% subscription in 2025. So the recurring revenue mix barely moves inside any single business, but it does move at the portfolio level because they keep bolting on new ones. So it looks like they took on some additional businesses like AOL that are not solely subscription revenue. Net revenue retention, it was 94% in Q1 of 2026, 93, 91, 95 if you go back the last 3 years. More on this later, okay? So 94% net revenue retention. That's not gross, it's net. Net income in FY 2025, basically zero. It was negative, if we're being pedantic here, it was negative 200K, down from 89 million in 2024 and 161 million in 2023. Those were positive numbers. So adjusted net income, FY 2025, 376 million. So that is up from 229 million and 96 million in the prior 2 years. And please hold that big old gap in your noggin for a second here. Cash on hand, 741 million. Total debt, 4.4 billion. Net debt's around 3.6 billion. They got a lot of debt. Interest expense on that debt, FY 2025, 143 million. That grew 337% year over year. So Q1 alone, they paid interest expense of 93 million. Okay, here's something that's great. Revenue per employee, or Spooner, 2.57 million per employee in 2025, up from 1.12 million in 2023. This is one of those incredible numbers that you'll see in software when you do it right, that you have leverage in your operating model. And it's core to, honestly, this company's entire thesis. Target valuation, big number. Well, I guess it's not as big as SpaceX and OpenAI and Anthropic, who are also crowding up IPO airwaves. 20 billion and raising a reported 1.5 billion to do more acquisitions. The growth here is mostly bought. So revenue grew 95% in 2025. And like I said, pump the brakes before you tattoo that on your forearm, because organic growth was 13%. They define organic the honest way, which I respect. They said this year's revenue over what the same business did last year, pre-acquisition revenue included, was 13%. So of the 95, roughly 82 came from wiring money to sellers, and 13% came from the businesses they already had in-house when they started. 13% on a portfolio this size, it's okay. Yeah. Buying growth is their entire model. So I'm not going to clutch pearls about acquired revenue at an acquisition company. Gives me more pause is what's living inside that 13, because Bright Cove revenue went down last year as subscribers left. Splice shrank the year before, and Evernote grew revenue while losing subscribers in some years because they raised revenue per user faster than the users walked out the door. A good chunk of the organic line is price hikes and monetization squeezes pressed onto a base of customers who've been there for a while that is slowly leaking, rather than this bustling turnstile of new humans who are showing up. And the net retention number that I mentioned validates that as well, because their blended NRR sits in the low 90s, which means the existing base shrinks a bit every single year before new logos try to plug that hole. By business, the spread is wide. So Evernote is 99%, AOL's 95%, StreamYard's 91%, and Rimini is 87%. And keep in mind, many of these companies are consumer or prosumer facing with little expansion potential other than price hikes, right? You can't like sell more Evernote licenses to one person. Like, you only need one. And the contracts are largely month-to-month subscriptions through app stores or on credit cards. So retention becomes even more important when it's structurally harder to upsell and cross-sell. So you're buying a 13% organic growth company that touts a 95% inorganic growth headline, which it depends which number resonates with you, right? Which person are you? It probably says more about you and the company, okay? So this is truly a house of adjustments. Their net income went down 3 years in a row while revenue tripled. Yeah, and that's not a typo. So GAAP net income was 161 million in 2023, 89 million in 2024, negative 0.2 million or 200K in 2025. So the company's preferred number is actually adjusted net income, and that went the other way. It always does, right? It always adjusts the other way. 96 million, 229 million, 376 million most recently. So you got to really work out that quandary in your head. Here's what they add back to get from a GAAP operating income of 278 million to an adjusted operating income of 613 million in 2025. How do you get there? Amortization impairment of acquired intangibles, zap out 151 million. Transaction-related expenses, kill 85 million. Reorganization-related expenses, kill another 79 million. Other items not indicative of core performance. What could be in there? Woo, 21 million. That is 335 million of adjustments, which is more than the 278 million of operating income they actually reported. So get this, the add backs are bigger than the profit. Love it when they do that. Now, some of this is defensible. Amortization of acquired intangibles is truly a non-cash accounting artifact of buying companies. And at a serial acquirer, it's permanently elevated. It's absolutely their favorite line item, you can tell. It's the same like how adjusted EBITDA was every leveraged buyout's favorite line item in 2007. So if you're going to own a roll-up, you have to be at peace with adding back amortization or you will never see the cash. The reorganization line is where I would slow down. So, quote, reorganization-related expenses is the cost of firing the people at the companies they buy. It was 79 million in 2025. And more strikingly, 76 million in Q1 of 2026 alone, which is about a quarter of that quarter's entire adjusted operating income. So remember the playbooks, the principles. Step 2 is the restructuring. Cutting Evernote from 341 people to 60 is less a one-time event and what they do over and over and over and over again when they buy a company. It's the business model. Yes, it's one time, but it's what they do one time over and over again. So when the recurring cost of running your business is being treated as a non-recurring add back, the CFO's ears should, they should perk up. And then there's the tax, which is why GAAP net income is such a mess. In 2023, a 103 million tax benefit flatten the bottom line. In 2025, the effective tax rate ran near 100% of pre-tax income of 111 million because net income of basically nothing. The Danish-founded Milan headquartered multi-jurisdiction structure, I would hate to do taxes for this company, makes the tax line jump around like a Rashid Wallace technical file. Get out! Ball don't lie, baby. Taxes don't lie either. Sometimes they do, which is part of why they want you looking at the adjusted numbers in the first place. This is a house of adjustments, and whether you want to live in it depends on how much of the cost of buying and gutting companies you're willing to call non-recurring. Maybe the first thought you had when you started a tech company wasn't about scenario modeling or runway management or the fine print of an S1. I love a good S1. That's not where the magic happens. It's more fun to build something new, design your quarter zip, or network with VCs. But what if you got your financials right early, long before your investors started asking for it? There's no limit to how far you can go and how many headaches you could stave off. Now, that's where EY comes in. EY has been a part of Silicon Valley since, well, it was just a valley. And it's helped some of the most successful names in tech go from startup to exit to mega cap. You build the next big thing, and with the teams across strategy, tax, audit, and transactions, EY will help you build your next big thing right. Learn more at ey.com/techstartups. That's ey.com/techstartups.